In this week's update, more rotation to growth boxes are being ticked. Is it time to make the call? Why do prices always seem to respond to news illogically? And the ramifications of a pretty dire energy situation in Europe. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. Another fascinating week, as usual. It seems every week is jam-packed with lots of volatility and lots of events. So let's do a quick status update. In Australia, it would appear that inflation is going to remain a significant issue, probably for longer than may be the case in the States. And the reason that I say that is that I think a wages spike here seems pretty inevitable, and it's really wages spikes that are one of the biggest problems of an overall inflationary situation. Now, the other thing, of course, is that with our dollar now down where it is because of the US dollar strength, then the weaker Australian dollar is contributing to inflationary pressures as well. So the outlook here in Australia is not particularly good. So that means investing in Australia carries, an additional level of risk or consideration, if you like. In the US, the data is saying that inflation is still accelerating and is still a significant problem, but stock prices and the bond market is telling a very different story. It's saying that inflation is really yesterday's story, and they're looking forward to more recessionary conditions, and therefore probably removes the need of the Fed to continue on their interest rate raising cycle. Beg your pardon. Now, the position in the US is it's still all bad news until Friday, when there was some retail data that was a little bit better. First of all, on Wednesday there was the CPI, the inflation at the consumer level, that came in above expectations and quite high. I think 9.1, I think, from memory. And then on Thursday night, the PPI, which is effectively inflation at the wholesale level, came in at, I think it was 11-something%, and both of those numbers are the highest levels since 1981. So there's no question that the actual data is saying that inflation is still a very significant problem in America. But we've got to remember that markets look forward, and they're looking at the situation as it will be in 6 to 12 months' time, and they're seeing something different. Doesn't make it right, but they're certainly acting as though inflation is not going to be a problem in the future. And on top of that, we saw the start of US earnings season. Started with the big banks as normal. JP Morgan missed, Wells Fargo missed. The outlook statements were poor, particularly from JP Morgan, where the CEO said the global situation was dire. So the news flow just couldn't have been any worse. But we continue to see a relatively positive market response, all things being considered, because we are at a momentous time in history. 4 decades of falling interest rates and easy monetary policy is getting reversed. So, of course, this is going to be a messy transition, and it's highly unlikely that we're going to see some sort of rapid V-shaped recovery. The circumstances, I think, are just too significant for that to occur. But there's no question we've been ticking boxes for nearly 4 weeks now, and the market is responding positively in America. And I've got another couple of boxes to tick this morning, as I'll show you. And one of those is the fact that we're now quite clearly seeing, particularly in the last couple of days, the intraday accumulation. And what that means is that prices are gapping lower on the open because of the bad news flow. So the retail, the less savvy institutions, the inexperienced are selling on the news, and they're dumping their stocks on the open, and then prices are pretty much turning around almost straight away and going up and finishing higher by the close of the session. So clearly, smart money is continuing to accumulate intraday. We saw this in 2020, we saw it in 2018, and we certainly saw it after the GFC, that the indices keep falling, stock prices might keep falling, but there is an intraday accumulation occurring by smarter money, and they're hoovering up the shares that people that are panicking are getting rid of. So for me, that's just one more box gets ticked. Now, the key battle to be won by central banks is not so much combating inflation and stopping the progression in the inflation data. It's really more about killing off inflationary expectations, because once that becomes an embedded attitude of the community, then that's the situation that central banks fear the most. And that was the situation that we had in the 1970s. So the central banks are more fearful of embedded inflationary expectations than they are of the actual data itself. So given that that's the backdrop of where we are at the moment, where do we want to be? And I've been working through this every week now for a month or more. And it's stocks that have got really good competitive moats so that they can raise prices in an inflationary environment so they can protect their margins. And there's not many stocks that can do that percentage-wise. So they're the ones that you want, because a lot of stocks are going to get really squeezed, even though they're good businesses, because they just don't have the ability to raise their selling prices of their product to offset the cost of their materials or their cost of production. I think we need to be heavily in stocks that are in megatrends, and there's several of them, because megatrends are going to ensure that long term the demand remains strong, even in an inflationary environment, even in a recessionary environment. The demand is going to remain strong. And the next thing that is really important is you want to have really high-class management steering the ship during times like this, because they're not easy. And a lot of management teams are going to be found wanting. So they're the things that I look for that are most important in the stocks that I want to own in this period. So it raises the question now that we've got yet more boxes ticked, and we've been progressively doing this now for 4 weeks, is the bear market over and is it time to buy? And I've obviously been reflecting on this for a little bit of time now, and the answer the conclusion that I come to at the moment is that if you're a conservative investor that really doesn't like the volatility, you're pretty shell-shocked and bruised, and you're very nervous about venturing back into the market, I think volatility is going to continue, even though we do have a lot of boxes ticked. I still think the market is going to still fluctuate around a fair bit. So I think for the conservative investor, you probably need a bit more confirmation. That was sort of, you're going to make your own decisions here, because this is only general advice, but I think the conservative investor is probably going to need a little bit more confirmation, and we'll have a look at what that looks like in the charts in just a minute. But the more volatility resistant investor, the ones that can start to accumulate now, and if the prices go down a bit more in the next few days or few weeks, it's not going to bother them too much, then I think the weight of evidence is now very compelling to start accumulating. So that's sort of how I see it at the moment. But I still think that having sensible stops is probably still a good idea, because it is going to be volatile. Things can pop up that changes the sentiment of the market. The market is very nervous. It doesn't take much to create a big wobble. So the key here is, it's basically your trading plan, which I keep on about constantly. All right. Summary for the American market: the S&P was down 0.9% for the week, but did finish well. However, just a word of caution, Friday was options expiry, and so the few days leading into that can create, just unrealistic price movements, because they're manipulated for the purpose of options expiry. So a lot of stocks that have been beaten down get manipulated upwards into Friday's close, and often we see the week after options expiry will often lag or go in the opposite direction. So I wouldn't be at all surprised to see a bit of weakness next week. So don't necessarily take that as proof that that markets are just going to go back down again. The US dollar index was up again, got over 108 at one stage, closed just a tick under it. The 10-year yield is down again, down to 2.92. The VIX was also lower to 24, and the 10-year, 2-year spread is now significantly negative. It's now minus 0.2. So the bond market is clearly saying recession is the outlook here. So other than the fact that the market is now pricing in a recession, which you're not going to have the Fed continuing to raise rates in the face of these sort of recessionary fears. Certainly not on the path that they're currently talking about, and that is why prices of growth stocks are turning around, because the market is looking forward and expecting that the Fed's rate of rate increases is going to cool off, and that's going to drop bond yields, and that's going to be better for growth stocks. So let's take a look at some stocks, at some charts. So we'll start with the S&P, and if you look at the S&P and the Nasdaq, this is just a consolidation. There's no reason to get excited there, because it's just we don't have higher highs and higher lows. We've got some higher lows, but we don't have higher highs yet. So the S&P still looks indeterminate. If you look at the Nasdaq, pretty much the same. We don't have higher highs and higher lows. We've got higher lows, but that's all. We've got a wedge shape breaking, building up, so that at least is showing a bit more promise. But we certainly need to get above this level here, around 12,180, and ideally I'd like to get above 12,600. So for the more conservative investor, they'd be a couple of levels that I would be looking at: 12,180 on the Nasdaq and 12,600, depending on how conservative you want to be. Now, if we go to the spread charts, and this really gives you the accurate picture. This is the Nasdaq versus the S&P, and we are getting higher highs and higher lows, and we're clearly in an uptrending channel. But you can see that there is quite a bit of fluctuation, and it's certainly not a V, really sharp V like we've seen in the past. Perhaps like what we saw here in March. It's much more subdued, but nevertheless, it's an uptrend. And you've got to ask yourself, when the news continues to get worse week by week, why would money be rotating into growth stocks? And clearly that's what this chart is saying. And you have to conclude, you can only conclude that it's because the perception is that in 3 months, 6 months, 9 months time, yields are going to be down, and things on a relative basis are going to be better for growth stocks. That's the only conclusion that you can reach. Compound that with, this is the Russell 1000 growth versus 1000 value. So the ratio is rising, higher highs and higher lows. Money is rotating preferentially into growth stocks at what would seemingly be the worst possible time, or the most illogical time. Consumer discretionary versus staples, a very muddy picture here, but at least it stopped falling. So what this chart going sideways is telling you is that, money is, there's not a bias. Money is in staples and consumer discretionary at a similar sort of rate. This is mid-caps, mid-cap growth versus the S&P. And you can see mid-cap growth stocks outperforming the S&P clearly. Higher highs, higher lows. And this is small cap growth versus small cap value. So across the board, money is going into the more aggressive sectors at the market at seemingly the most illogical point in time. And that is the sort of behaviour that you see that marks significant bottoms in the market. It doesn't guarantee it, but it's certainly, a pretty reliable indicator. All right, just want to look at a couple of other charts. This is Apple, and you can see this is pretty good price action over the last couple of weeks. We've got higher highs and higher lows. I would ideally want to see a breakout above this level, but look at the number of green-bodied candles closing on or near their highs compared to the red ones. Since about here, we had one decent red one there. This was another one where it sold off, but look at the turnaround intraday. So what this red candle here is telling you is that the market gapped down a little bit, traded down, but then traded back up again. And then the next day, gapped down, traded up. The next day, gapped down, traded up. Very similar sort of pattern. Here, we gapped down on Wednesday and traded up. Same again on Thursday. Friday managed to gap upwards and hang on to it. And there's a little bit of a slight rising bias. Maybe I'm looking for things that aren't there. But a little bit of a rising bias in the volumes as well. At least the volumes are not falling as the prices rise, which would be, a sign of waning support from the market. So this is a very, very solid looking chart. And that's just another box that got ticked for me this week. This is the junk bond, HYG, the junk bond ETF, and we've now broken out. And that's a really positive sign from the bond market that they're going more risk on is really what this is now telling us, and significant volumes over the last couple of days. So this is not what you would expect to see given the data that we've seen in the last 3 days. Semiconductors, they're really essential for the next bull market, and they've been weak. They were really weak. But again, we got a gap down on the 5th of July, a very significant gap down, and then it traded up and closed on the highs. And ever since then, it's gone up. That's a very telling turnaround in a very essential part of the market. Now, this is XLF, which is the financial sector. We're sitting on very important support. So it goes back quite a long ways. And we're just getting horrible data from the banks. They're all missing expectations and have got gloomy outlooks. Yet look at what happened on Thursday. Thursday, big gap down, but managed to recover to the open price. And then look at Friday. In the face of a poor report from Wells Fargo, the prices gapped up. The market had decided enough's enough selling of the banks. XLK, so this is the overall technology sector. We don't have higher highs, but we do have higher lows at this stage. So this is building up into quite a nice triangle. So if we can get above this level here at around 133, so these are all the things that the more conservative investors should be looking at. These are the lines in the sand if you're a bit more conservative. So, is this just a bounce? It's possible that this is it, and then we go down again. That's possible. But to me, that's a low probability now because there's just such a weight of evidence the other way. So is it a bounce or is it the start of a new uptrend? I think the odds overwhelmingly it's the start of a new uptrend. But you've got to decide who you are as an investor as to how you play it. This is XLY, the consumer discretionary. It's struggling a little bit, and that's pretty much what you'd expect because the consumer around the world's getting squeezed with inflation, higher interest rates, higher fuel prices. It's going to be a difficult environment for some time for the consumer. Okay, that's the US market. Let's look at the currency. So the currency actually peaked at 109. It actually got to on Thursday. So it's been a very, very strong rise in the US dollar. And of course that has punctured the Australian dollar. And we actually gapped down on Thursday and opened up in the low 66s. So it's been a meteoric fall. It was only just back here in April that we were trading at 76 and seemingly headed to 80. And again, you never want to take notice of the news. I can remember on and around this day, all the predictions came out. The Australian dollar was heading back to 80 cents. There was a whole heap of them. And since then, all the Australian dollar has done has gone down and gone down significantly. So, never ever trade the news. All right, moving now to Aussie Stocks. 67.23 is where we finished. Our index rose 2.1% across the week. And, we probably should see positive trading conditions on Monday. I'm expecting around the world that stocks from here on in are going to trade on lower multiples for a lengthy period of time, and I'm talking probably several years at least. The period where stocks traded on crazy multiples of sales with no profit in expectation of profit in future years, that's gone. And I don't know when that'll return. It could be decades before we get back to that sort of mindset. It might happen in individual stocks, but not on the broad brushed level that we saw over the last few years. And the reason that happened is because money was essentially free. And so stocks that were they were losing money, but it was all about a land grab for market share around the world. And when money was free, they could just try and grow as fast as they possibly could, and the market rewarded them for that. Well, that period of easy money, almost free money, is now gone and won't be back for a very, very long period of time. Probably not within my lifetime, to be honest. So therefore, it's a reasonable expectation that the PE multiples are going to be lower than they were in recent years, and that stocks that don't have earnings or earnings visibility are probably going to have very, very soggy share prices indeed. And many businesses will go out of business during these next few years as well. So it's going to be harder in most sectors, but not all, and that's what you've got to focus on. And that's what we do in the memberships, constantly looking for stocks that tick all the boxes, fundamental as well as technical. Now moving on to precious metals, gold lost another $36, almost broke $1,700, so it's fallen very, very sharply in what would appear to be an inflationary environment. And again, I think the precious metals market is perhaps looking forward and saying that they don't believe that inflation is going to be a continuing issue. The next support on gold comes in at 1680, but as I've been saying all year, I don't have any confidence in gold at the moment, and it's just not a sector that I'm prepared to do anything with, unless it is world-class developers that have got undisputably a world-class asset that they're continuing to build, and as they approach production, which still might be a couple of years away, the market will acknowledge that. because those stock prices can go up without the price of gold needing to go up to support it, whereas existing producers, they're just going to fluctuate up and down according to the gold price. So GDXJ is now very oversold, so wouldn't be at all surprised to see a bit of a bounce. So let's take a look at those couple of charts. So first of all, we'll have a quick look at the ASX 200. So there's the 200. We should start to see a bit of a bounce, but there's one of the culprits, and that's materials. So they've been heavily marked down because iron ore has fallen, oil has fallen, all the base metals have fallen very significantly because of the US dollar and recessionary fears. So the materials sector has been hit pretty hard, and that's put a drag on things. Healthcare has done very well. A lot of that is due to CSL, so it's been a very good period for healthcare majors. The banks have managed to hang on; they've rebounded to a degree, but I think the banks are going to have a bit of a struggle in this sort of environment. And energy has come off a bit, but energy, this has done better than American energy because it's been cushioned by our falling dollar. So that has helped. So looking at gold, this is gold on a daily. You can see it's just been down since the breakdown, which really started on the 5th of July. And if we take a wider view, here's our support now at 1680, pretty critical. If that breaks, then you're probably looking at 1550 below that. So not a good outlook for precious metals. Silver has done even worse. It's well down. If we just pan back and take a wider look at silver, so you can see silver has really been punctured very badly. And this is what happened in the GFC, happened in the COVID crash. Silver got absolutely murdered, which I must admit I don't understand the mechanics around what causes that, but we can see it very clearly when we go to the spread charts. If we look at so this is GDX. This is GDX versus gold. So this is gold stocks versus gold, and you can see this has been clearly leading the way down, and we don't appear to have found a bottom yet. But as I said before, very, very oversold. So I wouldn't rule out a short-term bounce. So something like this. I think we're so oversold now in gold stocks, we might get something like this, but this is not something investors want to try and play. This is a short-term trader's play. So if you're not one of them, then you probably just need to stand back and watch. Because if we do get a bounce, the trend is very clearly and very strongly to the downside. This is gold versus silver. So you can see what happened in the COVID crash. That ratio, which should normally be somewhere closer to 0.5 or 0.6, we actually got to a peak of 123. So in other words, 123 ounces of silver to an ounce of gold, which is way, way above the long-term moving averages. And again, as things get more and more difficult, then that ratio seems to expand. So this is the other way of looking at this, is that silver is being sold off much faster than gold. That's what that's telling you. All right, turning now to other commodities. Copper was lower again, and they've really been smashed. Copper, it wasn't that long ago, copper was $4.50. And nickel, of course, with that disruption in the nickel market, got above $20 a pound. Nickel down to $8.74, and it's still just a combination of recessionary fears, which I think are being overdone, and the US dollar. And I mean, that's the short-term reality. That's what the market is doing to these base metals. And clearly, copper is a barometer of whether we've got buoyant conditions or recession. The copper market is screaming recession. There's no question about that. So I think it's far more likely now that we do enter recessionary conditions. But offsetting that, we've got the whole decarbonisation, electric vehicle, revolution, which is going to increase the demand for for battery materials. So on the one hand, you've got recession reducing the demand for particularly copper, and that's probably valid. So it's a question of the balance between the rapidly rising demand for copper for decarbonisation and for nickel and for all the others, and the falling demand due to recessionary conditions. So at the moment, the market is not taking any prisoners. It's saying the recessionary thing is going to make the demand worse for copper. But when you look at the inventories, that really tells a different story. And that's the importance of looking at the inventories as well, which I'll do in a minute. Now, crude oil also fell further. It was $120 only a few weeks ago. Now we're down under $100. And again, we've seen a $15 weekly range. I think that's the third week in a row. So it's very volatile in the crude oil space, and that's come off quite dramatically. And again, that's the recessionary fears. The market has got over the fear of what was happening with Russian oil, and is looking more at recessionary conditions. So there's the 1 year spot copper chart. So you can see it's just been a meteoric decline. But there's the 6 month warehouse levels. Now, if indeed demand was going to fall off quite dramatically, to my way of thinking, we should be seeing a build-up in reserves, because production is getting ramped up to meet the decarbonisation theme. I would have expected to see a bigger ramp up in the copper warehouse. So the market is looking forward and is saying recession, but it's not yet being reflected in the inventory levels. There's the spot nickel chart. It's not come off as dramatically as it has with copper. And the inventory levels continue to fall with nickel, and that's probably why. So that's the situation in the base metals market. Wrapping things up, this is not a time for the traditional diversification and managing risk by diversification, because my expectation is just to pluck a number out of the air. I would expect that significantly more than 50% of the market in Australia and probably around the world is going to struggle. So why would you want to have more than 50% of your portfolio in stocks that are going to struggle? Why wouldn't you want to have the bulk of your portfolio in stocks that are probably going to do well, at least on a medium to long-term time horizon? So my view is that we must go where the tailwinds are the strongest and the most assured. The decarbonisation thing is just going to keep getting stronger and stronger to pick one of the mega trends. Add to that, and you don't want to just buy any stock that happens to sit in a mega trend area, because there'll be a lot of low quality stocks in that area, and we've seen the punishment handed out to mining stocks. Copper and nickel and lithium stocks have been hit very, very hard. They're all in the right areas, but a lot of them just are either low quality or they're not sufficiently advanced for the market to reward them. So the assets need to be unquestionably high class, world size assets, where management is proven, because it really is going to require good management through this period, and where prices are modest. That's the formula for doing well over the next few years in the market. Portfolio analyst last week, we focused to a degree on portfolio construction. There's a lot of material in the memberships on how to build a trading plan, how to put your portfolio together, and I think members have found that extremely helpful. And once you've got clarity around that, then all decisions just become so much easier. We also looked at the facts around lithium rather than some of the silly reporting that's out there from some quarters. So it was a good session again in Portfolio Analyst. There is a There is a $1 trial for anyone that hasn't tried Portfolio Analyst for a couple of weeks, and I think you'd find a lot of valuable material in there. I also took a look at Linus Corp as an example and did a sensitivity analysis on it to just see what worst case scenario should do to the share price. Would that indicate that perhaps Linus was overvalued in a worst case scenario situation? So that was very interesting. All right, that's it for this week. There won't be a video next week. I'm going to be having a milestone birthday on the Sunday, and I just want a Sunday off. So hopefully everybody understands, and I'll be back with you in 2 weeks' time. There's more information on the website. There's my email address, and let's see what the next couple of weeks brings, and I'll be back with you then. Cheers.